Hi, everybody. Good evening. Welcome to the third session of our four-part New Dentist Survival Guide series, Setting Yourself Up for Success. I'm Dr. Jerica Cook and the chair of the NISTA New Dentist Committee. This is the third year we are offering this webinar series to new dentists across New York State, and we want to thank Milmic for being our sponsors for this webinar series. Milmic and New York State Dental Association have worked together since 1992 to provide dentists the best liability protection available at the lowest possible premiums consistent with fiscal responsibility. Milmic policyholders from Buffalo to the Bronx enjoy localized risk management guidance, claims protection, and underwriting support, in addition to benefits and expertise not found anywhere else. A little housekeeping. At the end of the program tonight, you must respond to a 3-question survey to receive your CE credits. We will hold all questions until the end, and please submit your questions to the Q&A section, not in the chat. Tonight, Rob is going to talk to us about what we need to do to get our personal finances in order and the role a business plan plays in the success as a practice owner. Rob is the Vice President and New York and Connecticut Regional Manager of the Dental Division at Bank of America Practice Solutions. He joined the Practice Solutions line of business in March 2013 and has over 20 years of experience in the dental industry, working previously with the 2 largest dental companies in the market, and has helped over 500 dental clients with their goals of practice ownership and expansion. Welcome, Rob.
Thank you so much. I appreciate having this opportunity to speak and to hopefully give you guys some content that you could take away from this. Just one second while I share my screen. So, as Jerica said, I work for Bank of America Practice Solutions, which is a specific division of Bank of America that deals in healthcare lending. So I'm sure everyone has heard or has maybe listened to the news in the last month or so about what's taking place in the banking industry. Just want you guys to understand that we are a national bank. We are not a regional bank that has any sort of issues or underlying problems. The 2 largest banks in the country are Chase and Bank of America, and Chase does not have a healthcare division. So just keep that in the back of your head. And why I feel like that's important is with the economy and some uncertainty, I feel like there's a lot of value working with larger institutions in terms of lending. And specifically, you being dentists, it makes a lot of sense to work with banks that do offer a specific division that understands your line of work and your occupation. So today, we're going to cover a few different things. And like Jerica said, I would like to answer any questions that you may have at the end of this presentation. But for the time being, I'm going to try to roll through this and provide you some good content. So the first thing we want to cover is banking and the dental market today. For those out in the field, I would like to just give some insight that we're seeing from the banking perspective. We're also going to cover a credit profile, what a bank looks for in a future practice owner. And that could be also in relation to someone that's looking to purchase a home. We're going to talk about the importance of credit score because it does play such a huge role in your life and your ability to assume financing. And we're going to talk about just borrowing wisely and putting together or starting to put together an action plan, right? And building your team and the resources that you're going to need further along in your career. So what does the lending market look like today? So the good thing about the situation today is, with all the things that are taking place in the world, banks that specialize in healthcare have not stopped lending to doctors. In fact, some numbers that I think you'll find interesting is this past year has been the best year for us from Bank of America Practice Solutions in terms of healthcare lending. We've done over $2 billion in loans to doctors that are looking to start or build or acquire offices. And I'm happy to say that 2022 and the start of 2023 already have been 2 excellent years for myself professionally. I'm working on over 50 projects currently with dentists throughout New York, and that number should be exceeded by this calendar year as well. And one of the things that makes your occupation so special is that you have banks that will have specific products that are designed for you, right? That they're designed for you to be able to start, grow, and pursue entrepreneurship, right? And those products provide 100% financing, which, if you think about other small businesses, and I'm sure that a lot of you here that attended have people that either started or are considering starting small businesses. It's very hard for them to get 100% financing to move those businesses forward. So you guys are all sitting in a great seat, and the market is actually very robust for you if you do decide to pursue practice ownership. So the dental marketplace today, and I feel like these are some strong points that you guys should maybe even think about as you kind of move forward in your career of what's taking place. So retail is moving online. So what that means is we're seeing a lot of small businesses that were normally brick and mortar move to online retail. And how that impacts you is, being a healthcare service provider, you actually need physical space, right? So as people or as small businesses move online, it allows for more opportunity for doctors to start if they're interested in starting, or even additional locations, right? And we're seeing it. And in this market as well, as I think something good to know is, like, as interest rates move up, which they have been pretty, I would say, consistently for a little while now, landlords are also more willing to negotiate. COVID, not to talk about that too much, but it did play a little bit of a role on how people view dentists assuming spaces, like dentists moving to state spaces to start up their practices. It's a lot more consistent of a tenant with a lot less risk. So landlords were forced to basically accept that and understand it a little bit better because of what took place with all these retail shops and stores moving online. We're also seeing a lot more dentists pursue purchasing, not just leasing. A lot of times, I would say the split is around 90% of dentists that start or acquire an office will do it under the terms of a lease agreement. But what we're seeing now is banks like us and some other healthcare lenders have created vehicles for them to be able to purchase the real estate that houses their business. Obviously, it's a little bit different, right? If you're starting an office, you're going to have to inject a certain amount of money into that real estate purchase if you pursue a real estate ownership. And if you are acquiring, if the actual income from the practice you're acquiring can support the mortgage, we are able to finance that. But whenever a first-time practice owner is pursuing real estate purchase, they do have to come to us with a stronger liquid position to be able to execute a purchase in that place. And like I mentioned before, in New York, I've seen it pretty consistent now. Landlords are giving more to tenants that are coming in that are dentists. They appreciate the thought process that you're going to be securing a space for 20 years. And that's a huge win in the market. So obviously everyone sees this every time they probably go to a grocery store, but there's an increase. Pricing has increased across the board, whether you're shopping for groceries or building an office. So what was normally an average, I would say, in the New York market for doctors that were starting was probably around 600, maybe 550 to 600. That has increased. Project costs have increased across the board. So business propositions or starting offices have cost more money. Now, if you're looking to acquire an office, what we're seeing in the market, and it's been like this for some time, it's a seller's market. There's not as many good practices on the market as we would like, right? So the sellers have the ability, if it's a good practice and they list it or they're promoting the sale of that office, they're able to create a significant amount of competition and drive up the price. And as we all know, value of anything is determined by the competition in that situation, right? The more people are looking at the same office, even though it could have been evaluated, it does drive up the price. Generally, we're seeing practices sell from anywhere from 80 to 90, sometimes 95% of gross production. So, that's saying all things being equal, but we are seeing it as a competitive marketplace, and something that is not on the slide, but is definitely taking place, is doctors that are initially pursuing acquisitions because they like the idea of a purchase of goodwill and a patient base are now starting up because the options are not there, or the time, obviously, component that takes place of looking for a place that you would want to purchase and a practice that is healthy, that you don't have to maybe inject so much into, is not always easy, or it takes a longer period of time. So why would you want to have an office, right? And, I think this is different for each person listening to this. It also is based on your experiences. I would say I field at least 2 phone calls every couple weeks, I'll say, of a dentist calling me saying, I need to start my own office. I need to acquire my own office. I'm an associate and I'm smarter than the person I'm working for. And I think at some point, it's important to seize control of your career path and control of your profession. What we see is about 85% of doctors will, especially in the dentistry world, will pursue practice ownership, and it could be a single, care provider or with a partner. But it's about 85% of the people that go into advanced education in healthcare will pursue it. So when you are an associate, you're unable to practice dentistry the way you would want. Obviously, we don't have control in terms of the way treatment is done in some cases. Obviously, one of the benefits is you're not assuming ownership responsibility. If you're an associate, you don't have to deal with the admin part of it, the business side to a certain extent. You are earning a steady income generally. Earning potential, though, most likely is capped, right? Most people are paid on production or daily plus production. So sometimes your earning potential is capped based on what you're getting on the schedule or what the employer is giving to you. No equity position in a business when you're an associate. Anytime you're being offered the opportunity for equity, don't let it just be verbal. Like, you want to see that on paper, even if it's for something down the line. Like, I cannot stress how important it is for you to be able to have in writing a future opportunity with a current employer. We've had it in the past where associates were promised ownership or percentage ownership over a period of time. They never received that in writing. And then when that time came, it never got fulfilled, that promise. So, those are unfortunately some things that happen. That's why it's so important whenever you're pursuing equity or ownership with someone else to have that in writing. So when you're an owner, obviously you have a lot more flexibility. You could create your own culture. You start with for the most part, you start with a canvas or a business model, and you're able to create what you want out of that ownership and that space and that that model. You have the ability to kind of run the practice and your philosophies the way you choose, right? You have control of your destiny, and that's some things that we've seen as well as a lot of times, like, you want to have the quality of life that you're trying to pursue, and that's why you go to advanced education, right? So having the ability to control your own destiny, having the ability to produce an income and not to be necessarily limited. Sometimes you're limited by the space, right? And sometimes you're limited by time. But in essence, if you market yourself properly, if you provide yourself with the right vehicle, there is no real income ceiling, because you could multiply, grow, and scale if you really wanted to. You have the ability to be impactful to your community on a positive level. We always talk about that. Some of the best practices that a doctor could own is a practice that's tied or connected to the community and that is doing well. Whenever people think about practice ownership, what they think about is, okay, it's going to give me income, but I want you guys to think about what else it does, right? And some of the things that I think we forget about is it is a vehicle for your income, right? How you're going to earn your income. But then the things that you have to think about is, it's also going to be a tax shelter. Because you're a small business owner at that point, you're going to be able to take advantage of a lot of tax laws, and you're going to be able to write a lot of personal expenses through your practice and lower your taxable income. Another thing that it does is it gives you the ability to potentially have a passive income. I would say a significant amount of our clients and our doctors have other doctors that work for them, whether an associate or a different specialty, and that's generating revenue while they're not even in the practice, So it's going to give you a passive income. It's going to give you equity towards retirement. It's your vehicle towards retirement. Not only are you earning income, potentially passive income, but you're also building equity. At some point, that equity, you'll be able to cash it out. And we collect a lot of data as Bank of America. I'm proud to work for Bank of America. We've been around for 25 years helping dentists start, grow, build, and scale. And within that 25 years, we collect data on all the dentists, all of our clients. And why that's so important is that data is used to create programs for you to be able to scale, grow. It also provides us with insight on how your profession is changing and growing, and what your needs are, right? And that data is how we create our products for you. And working with a bank that provides that type of insight, provides that type of specialty information is very useful. It's very useful for you to help you create a plan moving forward. But never underestimate your ability to assume financing, as long as your personal financials are in a good place, if you do want to pursue ownership, because ownership to you is significantly important for hopefully your quality of life, one, but also your financial freedom. So data that we've collected has shown that a doctor that associates for a 5-year period, as opposed to a doctor that is an owner for that same 5-year period, after they've gained some hand skills and experience, they potentially have a loss of income as an associate of anywhere from 250 to 500,000. And if you think about that on an even deeper scale, could you imagine you had 250,000 or 500,000 and you invested that for an additional 15 years? That could be the difference between millions of dollars in terms of an associate to an owner. So a lot of times, I think the fear is you assume so much student debt, like how am I going to make it happen? And we're going to talk about that because that is not a deterrent. A lot of times, I think young doctors are getting fed information that they'll never be able to own because they assume student debt. Based on what I see and I'm going through on a day-to-day, we've had our strongest years the last few years, and the student debt has continued to rise, unfortunately. But banks are not looking at student debt in a negative way, so you shouldn't as well. It's something that is an investment in yourself, and it will not deter a bank from lending you money for future practice ownership. So what does a bank look for? And this could be related to a home, if a home purchase is something that you're also considering. So first thing, credit score over 700. So a credit score is a reflection of your level of responsibility. So 700 would be the minimum. We obviously would want you to have higher than a 700, but 700 will not deter a bank from lending you money, and especially in a healthcare, for healthcare financing. And the difference between a credit score when it comes to healthcare financing for a practice as opposed to mortgage for a home, the higher credit score is, the lower the interest rate would be for a home loan. But for a practice financing loan, we just need you to meet the minimum, and then you'd be getting the best rate from the cost of funds at that point in time, right? And the only thing that would impact your rate is the cost of the money at that point and the length and time of that loan, how long that loan is or how short it is, right? So whenever a person comes to us and is looking to potentially purchase an office or start an office, we generally like to see 7 to 10% of what they're looking to borrow in liquidity. So when we talk about liquidity, we talk about things like checking, savings, stocks, bonds, mutual funds. anything that is non-retirement. I'm sure a couple of people are like, what about cryptocurrency? Banks have not yet recognized that as liquid, but we still put it on our applications, or I do have our clients put it on the application because it does show where some of your money is going, right? It accounts for some of the income that you've earned and where you've placed it. So non-retirement is not considered liquidity because there is penalties to access it, like a 401k or an IRA. That is not considered liquidity. So just keep that in mind when you're considering applying. Banks would like to see 10% of what you're looking to borrow. There is a factor of time. So like if you've only been out of residency a year and the average loan is 600,000 to 625, we wouldn't expect you to necessarily have 60,000, as a liquidity standard. The factor that you've been working for a year will also play a part. So it's not uncommon that you would be below the 10% that we're looking based on just the amount of time you've been working, not being that long. Credit card debt. So when we talk about credit card debt, we don't like to see, in New York, we generally see the average of 3,000 to 4,000 of credit card debt. We generally like to see sub 6,000. And when we look at credit card debt, we compare it to liquidity. So if a person has 10,000 of credit card debt, and we'll say 50,000 in a checking or savings account, or even in the market, it could be in the market as long as it's not in a brokerage, as long as it's not in retirement. That person that has 50,000 in the market and 10,000 in credit card debt would, to us, we would look at them as plus 40,000, right? That's how we would view them. So keep that in mind. We're looking at your credit card debt. Even if you're paying it off in advance monthly, how reliant are you on your credit cards, right? That is important to us. When we run into trouble is when people are overextended on credit card debt, which is very easy to do in New York, apparently. We see that more here than anywhere else. But when you're preparing to apply for something, you want to make sure that your credit card debt is low. That will definitely help you in terms of not only your credit score, but getting approved. Production. Generally, whether you're starting up, we like to see around at least 135 of annual income. And the way our bank looks at annual income, if you've been working 3 months as an associate, we're going to take those 3 months and annualize them out and make sure you hit that 135 number or above. That puts you in a good place. Obviously, anything over that is important. Now, when we say production, or when it's listed there, production, that's when we're talking about acquisition, right? We want to know how you produce as a doctor. Are you getting paid 33, 35, 40% of production? And how are you working? How many days? That level of income or your production numbers, if you're collecting monthly production numbers, which I always say everyone should if they're getting paid on production, just to validate and audit it. We use that information to determine what size of an office you could acquire, right? We want to make sure that it's a fit. We want to make sure that you are a fit for that practice. If a practice is doing 700,000 of, we'll say, general dentistry, if there's a GP, we want to make sure that they can handle that 700,000. So when the seller leaves, that the practice doesn't have significant attrition or not the ability to handle the patient load. So experience, right? This is unique. This is how much banks like ours love you. We actually will approve a doctor that is a specialist in residency to start or potentially acquire an office. And the reason we do that is because your default rate in the market is so low. Like, banks could not lend to a better small business. They always joke about it, saying that funeral homes are probably a little bit better than dentistry. But I mean, just think about the company that you're in. So the default rate is so low, we are willing to lend or prepare specialists in residency to start a practice. And when you're a GP, we do like to see you out and to get some experience, build up some additional hand skills for a period of 6 months to a year. That's generally when we see. I think on average, I would say an associate would work for 3 years before they probably get an itch and want to kind of explore practice ownership. There is a direct correlation between people that have student debt and pursue practice ownership sooner, being able to pay off that debt, just based on what we see in terms of like how our clients kind of move through debt and continue to grow in their own offices. So a little bit more about credit score, because it's so important on any transaction that you do with the bank. So scores range from 300 to 850. Obviously, our minimum is 700. There's 3 credit bureaus that have different algorithms on how your score is computed, right? And why that's important to you is different banks will pull from different credit unions, right? So you may have an application like Credit Karma, and it's showing you 1 or 2 of these bureaus, and your score looks great. Maybe it's a 770, but they're only reporting on a couple of them, and there's a different algorithm for the third that they're not. And why it's important to understand what your credit score is for each one of these is because if there's derogatory information on one of these, it could significantly impact your score, and it can impact you being able to get access to a loan, right? So you all have the option to request a free credit report at no charge from each one of these bureaus. And by requesting it, you could make sure or check on the accuracy. If there's something inaccurate in any of these bureaus, you could actually make a submission request to have it removed. And they have 30 days to justify it. And at that point, after 30 days, they will, if they cannot validate it, they will have to remove it, and your credit score will improve. So the number one impact to your credit score is your pay history, right? And that's just the longest card you own will be the most important. It will probably be the worst because you don't always have access to great cards when you're starting to pursue credit, but I would suggest never closing your first card. If possible, put like Netflix on auto pay, right? And just keep it on that card, because you're going to build a long positive credit history, and it's going to have the biggest impact on your score. Obviously, amounts owed is important, right? Banks don't want to always see you have significant balances, right? The lower your balance, the lower your utilization, the better you look to a bank. So that's why it's so important to clear out credit card debt, which is generally the higher interest debt before you apply for financing. There's different types of credits, and a lot of times you'll see your score move in a positive direction if you're able to manage multiple credit at the same time and pay it off timely. You do not need to hold balances to grow credit history. I think that's like a misconception we hear quite a bit. So if someone's telling you just pay minimum, because so you could grow your credit score, that's not going to help you, and you're going to actually pay more on that debt. Credit inquiries. So there's 2 types of inquiries: hard pulls and soft pulls. A hard pull is when you actually physically apply for something like a car loan, a bank loan, a home loan. A soft pull and a hard pull will impact your credit score. And depending on how your credit score is, your history, and all the components that make up that algorithm, it will impact it differently, right? But then there is a soft pull. A soft pull is when you're just requesting your credit score. You're not actually applying for something. So like a credit card statement may actually have your credit score, or even your banking institution may provide you with your credit score. Credit Karma, which is a fairly popular application, that application, there is no impact to your credit unless you are physically applying, or you're actually applying for credit through that app. But them showing you your score is not impacting your credit. So keep that in mind. And one thing that will impact your credit significantly is if you're doing multiple transactions that are all different around the same time. So like we had a client it was the summertime, and he was applying to get a financing for a boat. And he was also trying to get a loan for a practice ownership. And that client, after the fact, realized how significant his credit score was impacted because he was applying for multiple things. So that is a little bit different than if you were shopping for a loan for a home and you went to 2 or 3 banks to see what type of terms you could receive from them. And because the unions are intelligent enough to know that you're just trying to get good value on the financing, it's not as impactful because it's the same transaction, just you're exploring your options. So keep that in mind when you pursue credit, how it impacts you, especially if you have multiple things that you need to accomplish that will involve financing. So when we talk about liquidity, we talk about emergency funds. So what we didn't talk about is the bank is not trying to take your money. We just need you to have a rainy day fund, right? And what could be unexpected and why? They want you to have a safety blanket to fall on if you have an income loss, if there's any medical emergencies within your family, if you have additional family debts that come up, if you have a home or auto issues or repairs or things that you need to take care of. Banks want to know that you have money to be able to weather some storms. We're going to finance the opportunities 100%, but we need to know that you have a safety blanket moving forward. It mitigates risk, right? The more liquid you are, the lower risk that you won't be able to handle maybe a challenging moment in your life, right? So when there's a need for money. So banks will finance 100%, but they do want you to have that safety blanket. And that's why I just wanted to touch on that. So the way banks look at you, we're looking at your debt to income ratio. So that's your monthly debt payments, right? How you're living, and divided by your grossly monthly income. And in this example, it's 2,000 monthly debts, which is probably unheard of in New York. That's way too low. And your gross monthly income, which is hopefully way too low for you as well as young doctors. And the debt to income ratio being 33%, right? And that's a fair debt to income ratio. It's not the perfect, but it's very good. So, so the amount of monthly debts you have and the income in relation to those debts will come up with that ratio. And staying within, some of those lower percentages will make you look very attractive to banks, all day, whether you're looking for a home or practice ownership. So getting qualified, right? So whenever you get qualified, the way you should consider working with a bank, whether it's our bank or another, they're going to look at you and you're not going to pay fees to apply to get an idea if you could pursue practice ownership. It's a free look for them to help guide you, right? You're going to get some information on how to improve aspects of your personal financial situation, right? And the whole goal is to get you approved, right? So a bank is able to show you options, and you're able to pursue what you want to out of life. You want to be able to pursue practice ownership. We want to make sure that your personal financials are healthy, so you could go ahead and pursue that. Obviously, being qualified by your bank, whether you're starting up or acquiring a practice, is going to give you leverage. It's also going to give you information, free information, right? It's going to give you information on what size practice you could potentially look for to acquire. It's going to give you an idea of leverage in terms of what size space or rent you're able to assume. And it's going to obviously give you some credibility in the market, whether you pursue practice ownership through an acquisition or a startup. By being qualified, you could use that as leverage with sellers. You could use that leverage with landlords, right? And that's the whole thing. You want to have leverage. Whenever you pursue negotiations, you want to have leverage. That leverage is what's going to, one, hopefully, make them take you serious, right? And two, provide you with good terms, and potentially the ability to negotiate an asking price. So often when you pursue whether practice ownership through acquisition or a startup, they oftentimes will want to see that you're pre-qualified, or they'll ask you to submit your financial information, whether it be tax returns or proof of income. And so being pre-qualified by a bank is going to ultimately give you the ability to pursue or to further strengthen the opportunity for yourself. So understanding your lending options, right? So this is important because what is the cost of doing business? I think I've learned this a little bit later in life than I should have, but I feel like this is so important. because banks generally will make money from a client in a few different ways, right? They'll make money if you're pursuing a loan, potentially through the loan, but not as much as you think, or they'll make money on the back end when you actually have used the loan and there's business solutions that are provided by the bank, and those business solutions have, fees tied to them, right? So you should always investigate the loan from the front end as well as the business solutions on the back end. So people always think, okay, what's the rate? What's the rate? Rate is absolutely important. I'd be foolish to tell you that it was not an important piece, if not one of the most important two pieces of the puzzle. But how that rate is determined and how that rate and structure is created will have just as much impact on you. So for instance, one bank, we'll say Bank A, is giving you a loan for $600,000 and they are charging you a 4% flat. And Bank B is giving you a loan for $600,000 and they're charging you a 4.2% flat. Bank A is giving you all the money and you're paying interest on all the money as soon as you open the loan. Bank B is allowing you to draw from that loan and you're only paying on interest on money that's used, not unused money during a period of a project. While Bank A may seem cheaper because it was a lower interest rate, it may be actually more costly because you're incurring interest significantly on a larger dollar amount. Now, understanding the structure of a loan is what's going to help you make good decisions, right? How is that interest rate accumulating? What is the vehicle that's getting me from point A, from the start of the loan to the end? But then after the loan is closed, what is the bank doing, right? What are the fees for your merchant services and payroll? Are you getting any benefits for being a bank client, like cash back or better credit card terms? What is your checking account like? Does it have significant fees? And does the bank require significant insurance requirements that will make that bank a lot more expensive to you? Like some banks will require certain insurances depending on the dollar amount, and other banks will not. So you may be paying on insurances that you may not have to with other banks. So understanding the insurance requirements will also be a significant part of your monthly costs and overhead for running a business. And that's important. There is a value to the loan, but it's not just one thing, right? And that's what I want you guys all to understand. Get deeper into those conversations. Like when you speak to a bank, ask them what are they gonna offer you today, but what is going to happen when everything's complete in terms of a project or an acquisition? What vehicles or what options do you have as a banking client moving forward?
I just wanted to throw you a couple questions while they're in the chat, because I think one of them was related to the debt ratio. Does the spouse income also factor in? And Bethany, if you want to clarify if that's for the debt equity ratio calculation.
So the spouse income only comes into play if you wanted to or if it's needed. And what I mean by that is this. Usually we apply the doctor initially on their own. If the spouse is part of the household and contributes to the household, so a good example is there's a rent, right? And that rent is $5,000 and there's other, debts that the household's covering. Sometimes, depending on the loan and what's needed, that debt will need to be supported by two incomes to be able to put another practice loan on top of that. So we could include the spouse as income as a cosigner. And the thing about a cosigner, some people are like, I don't want to cosign a loan because then I feel like I'm responsible. What it does do for banks is it allows us to include the income in the accounting to make the deal work. Because the reality is if there's two people in a household, most likely both are contributing, right? Now, a cosigner doesn't need to be on the loan forever. There's points where we will add a husband or wife to a loan to support the deal so the practice loan could get approved. And then a year later, a year and a half later, maybe 2 years later, they're removed because the practice is cash flowing on its own. So So we don't include it unless we need to. And it doesn't need to be a permanent thing. It could be a temporary situation or solution.
Okay, so you have another question. Do you recommend paying loans off in small increments over decades or with more accumulated interest, or paying off quickly and saving money by having less accumulated interest? How does that impact possibly, going through the loan process as well?
So it depends on what type of loans we're talking about. So the student debt, right? You want flexibility. The reality is you want flexibility in all loans, right? You want to have the ability to pay off a loan in advance with no penalty, or at least pay down the principal with no penalty. So as your income grows, you could pay down the debt more aggressively and lower the effective interest you pay a bank back. Now, when it comes to applying for a loan and you have existing debts that you're trying to figure out what to do with, you want to balance paying the debt down, and you want to always pursue paying down a higher interest debt. But there has to be a balance, right? You want to pay down your debt, but you also want to show that you have the ability to save. So banks will want to see that you're able to manage and balance everything, right? By you showing that you're able to, one, handle your responsibilities from a debt load and the monthly obligations that you have to service, that's important. But then on top of it, they want to see that you're able to save money for a rainy day to protect you. So showing that balance is going to be the best thing, right? We've had doctors pay down student debt so aggressively, and maybe they were debt adverse, but they weren't able to assume financing because they had no money saved, right? They were so concerned or consumed with paying down their debt that they weren't able to pursue practice ownership when a good opportunity presented itself. Then we had other doctors that come to us and they've taken their student debt. And this is not, I'm not specifically suggesting this, but this is the importance of a financial advisor, right? You need to understand your short-term and long-term plans to see how you should play out your situation with debt and your loans and financing, right? So we had a doctor come to us and stretch their student debt out so they could have smaller payments, so they were able to get approved for financing so they could start a practice sooner rather than later. And those people generally, we see if they have some flexibility in the loan or smaller payments, they're easier to approve. We know that because the bank is going to use, if you're starting in practice, we're going to use information on future projections of income and revenue. And if you're acquiring an office, we're going to use the existing revenue or goodwill. So there's a couple different ways to pursue that. I would suggest that specific person that asked that question, maybe we could have a conversation. I think everyone has my contact information. I think Grazia is going to either send it out or she has already, but I would like to speak to them specifically so I could give them some proper guidance.
We did share your information before the webinar to those who registered early, but I'll definitely going to be sharing it out afterwards, because that's Isaac also wondered if he can reach out to you for other follow-up questions as well. There's one more question there, but I don't know how much more of this do you want to cover on your presentation. We can come back to that last question.
That's perfect. Yeah, I'll continue to move forwards just so we have enough time. All right, so a little bit of an action plan. And this is like if you're pursuing a startup, and I'm going to talk a little bit about acquisition as well. I'm going to try to, I see my time and I see I talk a lot, but I'm going to try to work through this. We'll call this the lightning round of our presentation. So first things first, you want to establish a plan. Like, you want to understand what you want to accomplish, whether you're starting up, acquiring. It's important for you to kind of put a plan. And Grazia had sent to everyone a business plan template. Now, banks don't all need business plans, but you should have a plan if you're pursuing practice ownership. So I was able to get a business plan from Bank of America. You guys all have it in your emails if you registered, and you can take a look at that plan on your own time, but it will give you some information. Now, that plan, you're not going to know the answers to everything on a business plan. And a lot of it is future projections, right? But the good thing is it gives you a reference guide for you to be able to just ask yourself certain questions, right? And that's just as important. Asking the right questions and understanding things to consider is going to make you so much better about pursuing an opportunity. So now the good thing about like working with a bank that specializes in healthcare, or even a financial advisor that specializes in healthcare or working with healthcare clients, is they're going to be able to help you establish a budget. So like going back to what I was saying, like banks collect a lot of data. Like we collect so much data. You know, we provide our clients with an idea of what they expect on revenues, future revenues, income, especially the first 4 years, which are the most challenging. So making sure that you're working with someone that understands your industry is going to be super important in helping you get some free information, understanding how to establish a budget. Now, getting pre-qualified gives you leverage. It also gives you free information on what size office you could get and what you could pursue in terms of a space. And that information is given to brokers, and those brokers work on your behalf. And those brokers will take that information and look for spaces for you while you continue to work clinically. And they'll pre-qualify those spaces to be dental offices, or eventually, if it's an actual practice acquisition, they will list practices and they'll want to know that you have the ability to assume them before they give you access to review the practice, tax returns, financials, evaluations, and to see the space. So finding a space, right? So finding a space, once you find a space, this is what I call the due diligence part of just working with a healthcare lender, or, you know, getting yourself prepared for a startup. So once you find a space, you're not going to just automatically make an offer. What we generally try to do is get an equipment person into that space. It doesn't cost you anything. They're going to do a preliminary layout, which is basically a two-dimensional layout that will show how the office is going to be equipped and how the workflow of the office is going to take place. We also like to have a contractor walk through this space that's specific to dental. By getting all that information, that will protect you when you submit your offer to the letter to the landlord. For instance, if a client sees a space and they love it, and then they pursue to offer a letter of interest to the landlord, and what the letter of interest does is it creates this feeling of negotiations. So, excuse me, just 1 second. It creates the feelings of negotiations. So the reality is you want to get information before you start negotiating, right? So by having a contractor walk through a space, they may be able to provide you with information like how long it's going to take to build a space. So if a contractor walks through the space and says it's going to take 5 months to build this space into a dental practice, when you submit your letter to the landlord, you're not going to ask for 5 months of free rent. You're going to ask for probably 10, because it's going to get negotiated down to 5, or maybe hopefully 6 or 7. But the reality is you need people to come in to do some free evaluation, to give you some free information for you to be able to actively, in a good way, negotiate that space. So once you find a space, that's when you're starting to build your team. You're vetting out contractors, you're vetting out equipment people, you know, through that process, potentially architects, and you want to finalize your designs. And finalizing your designs will basically show how the practice will be equipped today and how it will advance into the future. You know, while your practice is being evaluated, while you're in lease negotiations, which generally in New York take a month to 2 months, you're going to work on building your brand. If you haven't already, you're going to start working on putting together a plan and how you want to market, how you want to distinguish yourself, and how you want to kind of grow into that practice, you know, and that all happens prior to the start of the project. So I'm going to keep moving because I know I'm going to be short on time. So this is a quick snapshot of what an average budget we're seeing in the New York marketplace. So the average budget's around $625, and budgets for first-time practice owners cover construction, equipment, working capital, and potentially marketing. And that includes everything: lease fees, operating costs, permits, architect, cabinetry, miscellaneous, of course, any improvements. But your budget differs significantly based on your taste, right? You could buy a chair for $60,000, or you could buy one for 12. I mean, those are going to be the biggest impacts. And the fixtures, right? The fixtures and your taste in those fixtures in the space and the space design. So, but the average office is around $625 right now. And costs are different depending on the geography of where that practice is. If you're in urban areas, it's going to cost more. If you are in non-urban areas, it's going to be a little bit lesser in terms of cost. So just keep that in mind. Now, building your team, right? So this is important because a lot of these people that you're seeing, banker, real estate broker, attorney, accountant, architect, contractor, equipment specialist, brokers, marketing companies, human resource consultant, these are people that are going to help you. These are also people that specialize in their line or area of expertise. And the good thing is there's people in each one of these spheres that specializes in healthcare and a lot of times specialize in the dental market. So these people have information for you. Some of it is at no cost, so a lot of times when you're pursuing practice ownership, half the battle is finding the people that you want to work with and you want to vet them out. And we always suggest, always speak to 3 people, and no matter what you kind of pursue, to decide who you feel most comfortable going with, right? And those 3 people, you are the client. It's their job to earn your business. They should show you a level of expertise and understanding of what you need to accomplish. They should also provide you with value and service. And that value and service is going to be free information to help you not only to start or grow or build or acquire, but to help formulate a plan, right? Or to help you complete that plan. So make sure that you start vetting people out. And some of you probably have people already in mind. You just want to use people that are specific to your market. So what you could do today, and just remember, if you're pursuing practice ownership, like everything is a year in advance. So if you want a practice next year, your thought is to be talking about it today, because that's how long it could take. You want to define what you want to accomplish, and form that in a business plan. You want to make sure that you have your personal financial situation reviewed, and that financial situation will help you create a budget, because a bank will tell you how much you could borrow if you're starting up, or how large of a practice you could handle, and you could, finance. You want to establish a timeline of when you want to open, and when do you want to be in that office, right? That also has to play a part. It makes you committed to the actual process of starting or acquiring. You want to make sure that you have the right vehicle to be able to assume that, business endeavor, right? You want to make sure that the loan makes sense for what you're trying to accomplish. Loans are different. They have different structures. Startup loan is very forgiving. The assumption of that loan is you have 0 patients. So the payments are really low to start. For the first 4 years, the payments will graduate, so you don't have as much financial strain. If you acquire an office, you're going to have larger payments because you have existing patients, and that income existing will help cover those payments. When you're working on building a team, you want to make sure that those resources and that information and that team is all working towards the same goal with you. And sometimes it's good to have teams or people that you're working with that know each other, right? The reality is we live and work in a very small, unique industry, and the cream rises to the top. People that are good, their reputations will precede them. So working on building your brand today and in the future that fits your vision. Sometimes when you're pursuing practice ownership, sometimes we tell our clients to reverse engineer what type of practice you want. And you could do that by figuring out just the patient you want to treat, right? If you want to treat fee for service, there's only certain geographic areas that you could have that practice, right? If you want to have a community-based practice, it's a lot easier to do in the suburbs of a community that you're familiar with, right? Those are things that you should consider. Those are things that will help you make your business plan today a lot more effective. Make a list of people that can be free resources. Right now, I'm a free resource. I'm not trying to give you any money. We're trying to just give you some education. So I want to give you 2 minutes to ask me questions, apparently. Sorry, I talk a lot. But does anyone have any questions?
You do have one that we have in there, and I'm sure a few more will be coming in, but if you have a practice that has been evaluated, let's say for 2 million, production for easy numbers, should you have access to documentation of the gross and net pay that current owners take home to determine your estimate income to expect, and how much of this, in essence, overhead affects a buyer's negotiation for acquisition?
So, all right, there's a few questions there.
Yeah.
So first things first is, yes, we will take production by provider, and we will take the information of what the employees are making in that practice as associates. We want to make sure that the fit makes sense, right? We want to make sure that you could support the dentistry that's being done. And there's a plan, right? Is there a plan for the sellers or the associates to stay on? How does that impact you? If there is one associate that is leaving the office, would you be able to handle that production plus the sellers, right? So that will ultimately impact the decision-making, also will impact the amount of income that's given credit. But the most important thing in a situation like that, it doesn't matter the size of the office, it matters the real income that you're taking from that practice. Like a practice could do $3 million, but have a 2% profit margin. That's not going to help you. The banks will determine what the real income is for you, the buyer, when you take that office, and we will add back potential income from overhead that you shouldn't be responsible for into that equation to determine if the deal cash flows.
You also have a question, just kind of getting in touch with you. Thanks for a great lecture, and the best time or days to contact you to speak more. Well, like I said, we're definitely going to be sending over, he's wondering if it's email or phone. I think it's both. Usually Rob answers everything.
I honestly, I'm kind of married to this job a little bit too much. The best time to reach me is Saturday at 5 o'clock. No, I'm just kidding. You can honestly shoot me an email and I will schedule a time around your schedule. I'm not opposed to evenings, mornings, or even weekends. I just want to make sure you guys get good information so you can make good, healthy decisions moving forward.
So what I'm going to do, Rob, right now is I'm going to have you just stop sharing your screen if that's okay.